All right, everyone, welcome to the Web3 Webinar by Ionixx Technologies. Today we're talking about DeFi, so we'll get right into it. I'll just give a quick introduction to the company and myself, and we'll start. So we're Ionixx Technologies. We're a technology company that builds enterprise and we build solutions for enterprises and startups, and our specialty is Web3, FinTech, and Health Tech. So those are our three core areas. A little bit about myself. My name's Sean Ray. I'm a technology researcher and Web3 specialist. I've been in this space for about 7 years, and I also have a keen interest in emerging tech apart from Web3. All right, so I'll get right into it. What is DeFi? DeFi is short for decentralized finance. It's just, you can just think of it as the fintech or the traditional finance system, except that it's decentralized in nature and it is censor resistant and permissionless. So in a nutshell, those are the main attributes of what's separated from traditional fintech or traditional finance. Most DeFi applications as of this recording, which is on the 26th of August, 2022, most DeFi applications at the moment are built on Ethereum. But as the ecosystem grows, I know that this ecosystem is probably DeFi itself is probably going to expand to different blockchains as well. Primarily, it's on Ethereum, but there are other blockchain networks that are kind of joining the system. So features of DeFi. I know I just got into it, but here's a more detailed look. So the primary feature is that it's inclusive, in the sense that if you have an internet connection, a smartphone, and a cryptocurrency wallet, you can be a participant in DeFi. You don't have to get permissions. There's no credit checks. There's nothing of that sort. You don't have to go through all the checks and measures for that people do for traditional financial systems. This is more of a, from an enthusiast perspective, it's something that's democratizing finance. So it's opening finance up to the unbanked. While there's no permissions like credit checks and everything else, there are still strong checks and measures within the DeFi space. So you can't do a transaction unless you have the money to begin with. So there are those checks and measures in place. It's just that there's not. It's censor proof. So when I spend some money in traditional finance, there's that 30-second gap where once I tap the credit card, I'm still waiting on a confirmation of whether my payment went through or not. My payment could be denied, even though I could be in good standing with everything else, if the system picks up something suspicious, where let's say I'm buying something somewhere or in a neighborhood that I don't usually visit. So in DeFi, it's permissionless. So if two users want to interact on a DeFi system, the network allows them to do so. There's no bank or an intermediary in the middle that's kind of stopping them and saying that it can't happen. So its primary function is to make it inclusive. So it's an open source financial system, and it's peer-to-peer. Users usually interact using DApps or dApps, decentralized applications, and users maintain complete control over their assets throughout the process. In traditional finance, you kind of hand your assets over to a bank or an intermediary. Here, you're still in control of your assets the entire time. Smart contracts are an integral part of DeFi, and they kind of turn the financial rules and the financial logic and procedures into smart contracts and code. What this does is it makes it really easy to automate complex actions or complex processes. So with one click, you could kind of like apply for a loan or apply for some form of credit. In the traditional sense, this would be a loan application would take a lot of time and a lot of paperwork. Same thing would happen when you're applying for a credit card. But in DeFi systems, all of that logic is put into a series of smart contracts. And when you apply for something, you get the result within seconds because it does all the API calls and checks and measures that it needs to live. And within a few seconds, you know whether you're approved or not, or whether the transaction has gone through or not. By turning rules into code, users can automatically execute a wide range of processes, which in traditional finance, that requires a lot of manual supervision as well as a lot of manual checks and measures. Smart contracts make the transactions faster, cheaper, easier, and more secure for all parties involved. So those are the primary benefits. Smart contracts, they are the building block that helps you define all the logic and all the rules that govern your system. This slide deck will be available after this call. So I'm just gonna read through this real quick, but here are some advantages of DeFi. So It's decentralized, it's democratized, it's accessible globally, permissionless, transparent, peer-to-peer, and it's interoperable. So if I'm on a DeFi system here, sitting on the Ethereum network or sitting on a network of my choice, I can still interact with you or another user that's sitting on another network because it's interoperable. So there are several DeFi use cases. The three primary ones are lending, decentralized exchanges, and prediction markets. There's a bunch of other stuff that DeFi does as well, stable coins. There's a bunch of other applications that go into DeFi, but these are the three primary use cases as of this moment. Lending, decentralized exchanges, also commonly called DEXs, and prediction markets. These are, so notable concept of DeFi. These are important. These are it's kind of like the core tenets of the space. So money Legos is a term that people use in DeFi. It's basically like Lego, like the building blocks that you played with when you were younger, where you could construct a house or a truck or something using like different Lego blocks. So in DeFi, the concept is money Legos, where what they mean is that they'll program a little bit of code, and then you can use that as a piece of Lego, and you could create financial products by just stacking a bunch of Legos on top of each other, or just adding a bunch of dragging and dropping a bunch of different Legos with each other that creates a system. So money Lego means like a piece of logic which can be used in a much larger application or use case. Composability is the ability to take money Legos and compose them into a new structure. So new solutions can be built using open source code, or AKA money Legos as building blocks. And then you could take those and create something more complex, like a really complex lending system or a banking system or a credit system of some sort. So those are two interconnected concepts, money Legos and composability. Two other ones are liquidity mining and yield farming, and there's a difference between the two. So liquidity mining means providing liquidity to a DeFi protocol, and what the user gets in return is that you get a copy of you get a trading pair in your account, as well as you get some liquidity tokens from the protocol. So DeFi protocols have liquidity mining, where you actually give them you help them maintain liquidity in their system. Yield farming, on the other hand, is generating passive crypto rewards, or passive crypto income, if you will, by lending them to a liquidity pool. Yield farming also happens where the systems usually help you go to a place that's offering the highest yield at the moment. So you generate passive crypto rewards by kind of like putting your money in there, and then the protocol puts your money wherever the highest yield is received. So liquidity mining is tied to one project, while yield farming can be over multiple projects during a given time. And then there's a concept which is interesting. It's called impermanent loss. So let's say you need to deposit your money, or you need to kind of like tie up your money with a protocol for a certain amount of time. Sometimes what happens is that during the volatility in trading hours, or whenever the pair is really experiencing a lot of volatility during its trading life, there might be, your books might show a loss. But that loss isn't permanent, because if you don't cash out, once the volatility finishes, that loss actually it reverses. But if you have to cash out, let's say there's you're in a credit crunch and you need to take out your money because you need to spend it somewhere else or do something else with it immediately, then that would translate into an actual loss. So the loss is only realized if you withdraw it right away. Otherwise, it's impermanent. You see it on your system, but it's not permanent. You know it's going to go back to being either a break-even or a profitable position shortly. So impermanent loss is a concept to be familiar with when you're dealing with DeFi. There are other concepts. This is just a primary list. There are a few more concepts, and most importantly, the space is emerging. So as we move forward, we're going to see a lot more concepts develop. Some challenges and risks of DeFi, which are, I feel like there's four primary challenges. One is adoption rates. So even though we see billions of dollars in DeFi, it's nothing compared to traditional finance. So the adoption rate is really low at the moment. Bandwidth is a problem with some protocols, where they can only support a certain number of users or a certain number of people at a time. Crypto volatility and lost keys. I've kind of grouped that together, but crypto volatility means the price swings in a certain cryptocurrency during a span of even 12 hours can be so much that it could kind of spook some users. And another big risk is lost keys. So if you lose your public and private keys, then, or your private keys specifically, then you can't really access your wallet or your crypto or your account, if you will. And if you can't access it, you can't withdraw your money, you can't make any other decisions in the protocols. So that is definitely a big risk. And then lastly, badly written smart contracts, poorly written code. That's also a massive risk in the space. So those are 4 things to look out for. 5 if you separate crypto volatility and lost keys. So in conclusion, the goal of DeFi is to disrupt the financial intermediaries and democratize finance. So democratize it where the unbanked across the world, across the globe, have access to financial systems. These financial systems will have solid checks and measures in place, but the gatekeepers will be removed. So democratizing finance, like it's coming from a place of sincerity. There are a few challenges, and there's many solutions that are currently being being addressed or being created to address these challenges. So the space is evolving really fast, and it would help if you kind of kept an eye on it. I know Twitter is a very good space, LinkedIn is a good space, and then there's a lot of interesting crypto forums where a lot of these announcements and a lot of the developments can be tracked in this space. So this is my personal opinion. I think DeFi will inevitably disrupt the world of traditional finance. And this could mean that a lot of enthusiasts say that, DeFi is going to take over traditional finance. I don't think it might not take it over, but at the very least, enterprises will incorporate certain aspects of DeFi solutions into their traditional protocols and their traditional banking and financial systems, simply because DeFi has a number of advantages for the financial service providers as well, in the sense that it could help with lower transaction costs, it could help make things faster. So it could increase efficiencies to some degree. So I feel like a lot of traditional finance and a lot of traditional banking systems are going to look at DeFi solutions. Whether they go all out into DeFi is questionable, but they will definitely incorporate certain parts of DeFi into their traditional systems, for sure. And then I just wanted to kind of spend a minute talking about how we can help. There are several ways in which we can help. We can do basic advisory and consulting. We can help you guys choose a platform, help you translate the financial logic and processes into code, create your smart contracts, put all the checks and measures in place that you require. We can also audit and test your code. We can also integrate on-chain and off-chain oracles to your smart contracts. This means if your smart contracts include stuff or are based on real-world events or on-chain events, then we can kind of do that with the help of different oracles. We can also provide design support for your project, and we can help you create and launch the tokens for your DeFi project, as well as launch your DeFi project on a live blockchain platform itself. All right, and with that, I'll open it up to questions. I've got some information on how you can get in touch on the right side of the screen. So email. Our website's up there as well, ionixtech.com. And our email is, my email specifically is sean.ray@ionixtech.com. You can hit me up on Telegram, LinkedIn, or Twitter. Pretty responsive on all 3 of those. So yeah, I'll open it up for questions. So yeah, someone's question was that there is a stablecoin affiliation with DeFi. So there are some countries and there are some jurisdictions in which they're not very big on crypto. So instead of allowing crypto or allowing Bitcoin and the other protocols to operate, I mean, they can't really stop it, but they can fine you for using it. So instead of that, a lot of these nations and a lot of these jurisdictions, they're going to come up with their own stable coins instead of the open cryptocurrencies that everyone else can use. The benefit of this for some states and some jurisdictions is that, like, while they retain control of the stablecoin, but like the stablecoin still it still allows participants in that jurisdiction to participate in the Web3, the metaverse, DeFi in general. Like, there's this whole world that's being developed and it's being born, and you can't. Even regulators that don't like cryptocurrency, they recognize that this is a huge growth space over the next decade, and it would be smart to kind of have a mechanism that allows people to operate in it, whether it's not cryptocurrencies. In that case, they might make it stable coins, where you could just buy a stable coin of your national currency, and in that sense, you could stake that or operate with that in the cryptocurrency environment. We have another question. How interoperable are DeFi systems? What's the tech driving it? So the tech driving DeFi systems is blockchain tech underneath it all. Most DeFi systems at the moment, as I mentioned earlier, are in the Ethereum network. But there are others being born on several other platforms. And the interoperability is great because the blockchain protocols themselves have interoperability within each other. So DeFi systems just, they're built on top of these platforms, and hence they're interoperable with other platforms. We have another question, which is, does DeFi have a role to play in cross-border payments? I think crypto in general has a role to play in cross-border payments because there are no borders in the crypto world. Everything is just one. It's just the blockchain environment or the cryptocurrency or the network, if you will. It can ease up remittance costs by a fair amount. And I think this is another example of where I think traditional finance is going to look at DeFi and different crypto systems to reduce their transaction costs and offer their clients or offer their users better prices or lower transaction fees. So this is a very good use case for that. Cross-border payments is a big one. So DeFi tokens. So we have another question, which is about DeFi tokens. Is it ideal for earning interest or obtaining loans? It's ideal if you actually. So there's two primary ways. There's yield farming, which is like you basically commit your tokens to or your crypto to a certain project, a certain protocol, and then a liquidity, and then they just kind of like go around yield farming at the best opportunities, and then the other ways are providing liquidity to a DeFi network. So those are two primary ways. And of course, impermanent loss is a concept that's related to that as well. That's something to be mindful of. So a couple of ways you can avoid that is don't have leverage positions or positions that are so leveraged that you might have to exit your DeFi position even if it's in an impermanent loss state. So holding power over a few days or a few hours is what might save you from that. And of course, trade responsibly, trade whatever you're willing to lose, etc. Any other questions, guys? All right, I think that's all we got for today. Thank you so much for joining, and we'll join. I'll see you guys again next week, where we'll be doing a different session. I think the session from next week is going to be on Tuesdays. We'll put that out on all our social media channels soon. Thank you so much.